Hello friends, are you considering retirement plans that promise lifelong payouts like those from major insurers? Today let's decode how those glossy brochures really mean for your pocket. Recently, I received these brochures from a sales representative, each showcasing impressive annuity amounts and return of premium benefits. But how do you calculate the actual return you will get from such products? Is the annual payout truly as attractive as it seems as compared to other investment choices? In this video, I'll walk you through a step-by-step method to find out the real rate of return so you can make informed decisions and avoid common mis-selling pitfalls. Let's jump on the Excel sheet and demystify returns from such products together. I have 4 variants of this product and we are going to evaluate all the 4 variants. Alright friends, so let's roll our sleeves and look at this Excel sheet together. You can see exactly how to calculate annuity returns for yourself. So let's create 4 columns. Okay, let's name the first column as 2 year dash 0 year. 2 years premium payment term and 0 waiting period. So your annuity starts from 3rd year onwards, immediately after premium payment term gets over. Similarly, we will name the other 3 columns also as 2 year dash 1 year, 2 year dash 3 years, 2 year dash 5 years. Each column will show a different scenario. Let's add one more column in the left. That will show the age of the policyholder. So let's assume that this person is of 40 years age and planning to invest in this product. We can fill this age from 40 till 101 years in this column. Now let's enter the number of variants. Now let's enter the numbers for the first variant. We invest 10 lakh per year for 2 years. Then the annuity starts immediately. So we will write 10 lakh in 2 cells and with minus sign. Minus sign means that the money is going out from your pocket. Below that, we will fill the annuity money that we'll get from the 3rd year onwards. All these numbers will be in positive. Let's assume the person who is taking this policy will live till 100 years so that he will enjoy a longest annuity period. On 101st year, his nominee will get the investment amount, that is 20 lakh rupees, back. If he survives, he will receive this money back on 101st year. Similarly, let's put the numbers for the second variant, third variant and fourth variant also. Here a deferment period has been added. In second variant, a deferment period of 1 year. In third year, the deferment period is of 3 years, and then in the last variant, the deferment period is of 5 years. Whatever is the deferment period, we will add zeros in the Excel sheet for those years, as neither will pay premiums nor will receive any annuity in these years. And then below, we'll add the annuity amounts as per the brochure. In the second variant, we'll get the annuity of rupees 1,08,160 rupees. In the third variant, the annuity amount is rupees 1,27,240 and annuity amount is 1,41,120 in the fourth variant. Now we'll add these annuities till 100 years, and on 101st year we will write the refund of investments, which is rupees 20 lakh. Now let's calculate the rate of return from the above cash flows. There's a financial formula in the Excel sheet called IRR. We will use that. It's very easy. Just write equal to sign, then open bracket, select the entire cash flows and close the bracket and hit enter button. You can see that in the first variant, the policyholder will earn 4.85% per annum rate of return. We will copy the same formula in the other cells also, and you can see the result. Now it's easy for you to take decision whether to invest in this product or not. I would suggest you to compare these returns with the returns that you're earning on your existing investments. I hope you'll remember this easy calculation to evaluate such products that offer cash flows. Always check the IRR to see your real long-term return, not just the yearly payout. That way, you will have the full picture before making your decision.